Hey there and welcome to the channel. In today's video, we are going to be analyzing a company called O'Reilly Automotive, which is a company that sells auto parts. Now, all the companies that I talk about on this channel, I either have on my watch list or already have in my portfolio. And in the case of O'Reilly, I have it on my watch list and will hopefully be able to add it to my portfolio soon. O'Reilly is in the specialty retail business, so there are a couple of key metrics that we need to understand when we are looking at a company like O'Reilly. First of all, we need to look at same store sales, and then we need to look at how many stores the company is adding each year. And in the case of O'Reilly, they are operating in the auto parts industry, so we need to understand concepts like do it yourself and do it for me. But the do-it-yourself segment is where somebody goes out and buys an auto part from O'Reilly and then puts it in his car by himself. Where the do-it-for-me or the professional side is where a mechanic is buying the auto part from O'Reilly and putting it into the car for a customer. Now, in the video, we're going to be going through my checklist of 118 items, and obviously not going to be doing them line by line since that would take forever. But we're just going to go over the highlights, which are, in my opinion, the most important things you need to know about O'Reilly before investing. We will then end the video by giving the company a score out of 118 and compare that score to their main rival, which is Autozone, which I made a video about a couple of weeks ago. You can check that out in the description. Before we get into it, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. And also leave me a comment below if you have a stock idea for me for a company that I could analyze and make a video about. So this is a relatively new write-up on O'Reilly's at the site valueinvestorsclub.com. And for those of you who haven't checked that website out, I would highly recommend it. There are some really good write-ups there. But in the write-up, the author is talking about the business mix for O'Reilly's, which is in the mid 50s in the do-it-yourself, while the do-it-for-me or the professional side makes up low mid 40s. And like you can imagine, the do-it-for-me is growing faster than the do-it-yourself. And that's likely going to be the trend for the foreseeable future because the cars are growing in complexity and it's getting tougher and tougher to be able to fix it yourself, especially as the electric vehicles and hybrid vehicles are making up a greater mix of cars on the road over time. So the company is getting more efficient as it grows in size, where we can see an expansion in the gross margin from 48% in 2010 up to 51% currently. And the company's sales per square feet has also increased from $216 in 2010 to $322 in 2022. Now, I was a little surprised when I read this, where the e-commerce penetration rates for the auto parts industry is less than 10%, but it does really make sense if you think about it, that the do-it-yourself needs speed and customer service knowledge, which is probably the key inhibitor to higher penetration from e-commerce. Now, the professional market or the do-it-for-me is still highly fragmented, where the four public auto parts retailers are O'Reilly, Autozone, Advanced Auto Parts, and GPC. And those companies have one third of the hard parts market, where O'Reilly has 11% of the $140 billion addressable market, and that should continue to grow over time. And really, the biggest competition for O'Reilly is AutoZone, where Advanced Auto Parts has been a steady share donor to those two companies. And we will be comparing O'Reilly to AutoZone later in the video. And if you look at the company's latest earnings transcript, they saw a very decent growth of 8% in comparable store sales, and they were able to get a 17% increase in diluted earnings per share for the third quarter. And some good news on the professional business side, where they saw a mid-teen comparable store sales growth in that segment in the third quarter. But like I mentioned earlier in the video, the do-it-yourself business is not growing as fast as the do-it-for-me business. But the company is still generating solid comparable store sales growth in the do-it-yourself segment. Now, in the earnings call, the company was also talking about the store growth and expansion, where they opened 40 stores in the third quarter, which brings them to a total of 140 net new stores for 2023. And they are confident that they will be able to achieve net new store openings of 180 to 190 for 2023. And they are projecting to open 190 to 200 net new stores in 2024. The company already has about 6,000 stores, so that would mean about 3% growth in their total stores. Now, we already touched a little bit on the key competing businesses, but let's go and compare Autozone and O'Reilly together and see what we can find out. And like always, we are using GuruFocus to compare the two companies, but I do think that GuruFocus is the best tool to keep track of your own portfolio. I am not in any way affiliated with GuruFocus. I just think it's the best site, and also it's a free option, which is really nice to have. So let's start off by comparing the free cash flow growth rate per share. And as we can see, O'Reilly is a much better company than AutoZone when it comes to the free cash flow growth. And like I do mention in almost all of my videos, I do believe that the free cash flow growth is the best measurement of the company's intrinsic value growth over time. Now, they are trading at a similar enterprise value to free cash flow, which is a little bit high in my opinion. Now, both of these companies have outstanding return on invested capital at around 30%, and it seems to be pretty consistent, seeing that the 5-year median is really similar to the latest return on invested capital. It is the same story with their return on capital employed, which is super high at over 50% for both companies. Now, both companies have pretty stable margins, where they have over 50% gross margin and over 20% operating margin, which for both companies is growing. The free cash flow margin is a little bit higher at 15% for O'Reilly compared to 11% for AutoZone. AutoZone has a pretty good interest coverage of 10, but O'Reilly's is higher at 16, and both companies have really low cash to debt. And what makes these two companies special is that both companies are what you would call cannibals. That is to say, they are super aggressively buying back their shares, and that is where most of the return is coming from, the share buybacks. That is because, according to the management team of both companies, they have been trading at below intrinsic value for the last couple of years. So management has been able to take advantage of the opportunity and buy back stock aggressively. Now, before we move on to assessing the management team of O'Reilly, I do want to talk a little bit about the headwinds for the company, which in my opinion is the increased adoption of EVs and the threat from Walmart and Amazon. And that is probably the reason why these companies, AutoZone and O'Reilly, haven't been trading at higher multiples for the last couple of years, because the market has always been waiting for either Walmart or Amazon to step into the industry and crush O'Reilly and AutoZone. That still hasn't happened, but we don't know what the future holds. Now, the other big threat is the adoption of EVs, which I think we can all agree on will eventually happen. It just depends on how long of a time you think it will take. But as EVs become the majority of the cars on the road, they will require much less maintenance than the normal cars. If we take a quick look at the ownership stake for the leadership team, we can see that David O'Reilly, which is the executive vice chairman, has $260 million worth of shares in the company, and Gregory Hensley, the executive chairman, has 31 million. Now, neither of those guys are probably in the day-to-day business, but as we read in the earnings transcript, Brad Beckham is going to become the CEO of the company, but he only has a $1.7 million ownership in O'Reilly, and Brent Kirby, which is the co-president, only has $22,000 invested. Now, when I'm assessing the culture of the company, I like to go to this website called Glassdoor.com, and see what the employees have to say about the management and how it is to work at the company. Now, O'Reilly has a lot of low-skilled workers working in the company, which is different to a company like Adobe or Meta, where you have a lot of high-skilled employees. And usually, when you have a lot of low-skilled employees versus high-skilled, the low-skilled employees are not going to be as happy working at the company. Now, that does not mean that I'm making excuses for O'Reilly, where they have on Glassdoor 4,000 reviews, which is quite a lot, and only 53% would recommend the company to a friend, and the company only gets a rating of 3.3 out of 5. And the CEO, which is actually quitting, only has a 61% approval rating, which is not that high. Now, I also like to go to this website, which is called dataroma.com, and check if there are any investors invested in the company, which I respect, and if they have a meaningful amount invested. And like we can see, Chuck Acre of Acre Capital Management has 8.8% of his portfolio invested. Now, Chuck Acre is an investor that I've learned a lot from, and my investment style is pretty similar to him. So it is really good to see that he has a meaningful amount of his portfolio invested in O'Reilly. Now, finally, if we try to value the company, we can see that they are trading at a free cash flow yield of 4.23%, which in my opinion is a little bit high for a company that is growing really slowly, like O'Reilly, where they have a market cap of about 53 billion or so, and they are growing their same store sales at about 8%, and they are getting 3% from their net new stores. So if we stay on the conservative side and say that O'Reilly will be able to grow their intrinsic value by about 8% for the next 5 years, we would want to see a free cash flow yield closer to what it was in December of 2020. But I would be happy buying into the company at a free cash flow yield of about 6 or 7%. So to wrap up the video, the company gets a total score of 75 out of 118 compared to their main rival, which got 70. Now, 75 out of 118 doesn't sound really good, but O'Reilly is a high quality company, in my opinion. They have a pretty simple business model, which is easy to understand, and their earnings are pretty predictable, which is really valuable when you're invested in a company. They are, in my opinion, the best company in the business and do have a competitive advantage against their rivals. The management of the company is high quality and is shareholder aligned. But the only problem with the business is that it's trading above its intrinsic value. That is the best problem you can have, since I do believe that at some point I will have an opportunity to buy into the company at a fair price. Meanwhile, I will use the time to try to read more about the company and study the industry and their competition, and I will try to be ready when I get the opportunity to invest. Now, I won't be making this video any longer today. I do want to ask you to like and subscribe to the channel if you haven't already. Thanks for watching, and I will catch you on the next one.